A world where money was everything, but humanity was nothing. Where the architects of our financial future built a tower of greed so high it blocked out the sun. You've been told that the 2008 financial crisis was a complex, unforeseeable accident, a perfect storm of bad luck and risky bets. But what if that story is a lie? What if the crash wasn't an accident at all, but the inevitable outcome of a system designed by Wall Street to privatize profits and socialize losses? Today, we will pull back the curtain on how a handful of powerful banks played God with the global economy, creating a doomsday machine that brought the world to its knees. We'll expose the secret ingredients of this toxic cocktail, from subprime mortgages to credit default swaps, and reveal how the game was rigged from the very beginning. But before we dive in, if you believe in holding power accountable and enjoy videos that untangle the complex web of finance and politics, make sure you subscribe. We have a lot more to uncover together. And let me know in the comments, where were you in 2008? And how did the financial crisis affect your life or community? I'm genuinely interested to hear your stories from around the globe. Let's start with a simple question. How could the smartest minds on Wall Street, armed with supercomputers and complex algorithms, not see a crash of this magnitude coming? The answer isn't that they were blind, it's that they were incentivized to look the other way. The system wasn't just broken, it was built to reward recklessness. To understand this, we need to go back to the early 2000s. After the dot-com bubble burst and the 9/11 attacks, the U.S. Federal Reserve, led by Alan Greenspan, slashed interest rates to historic lows, making money incredibly cheap to borrow. This flood of cheap money had to go somewhere, and it found its perfect home in the U.S. housing market. The long-held belief was that real estate was the safest investment you could make. After all, people always need a place to live, and house prices only go up, right? This belief created a feeding frenzy. Banks, eager to profit from this housing boom, started handing out mortgages like candy. They loosened their lending standards to a terrifying degree, giving rise to the now infamous subprime mortgage. These were loans given to borrowers with poor credit history, unstable income, and little to no down payment. They were nicknamed Ninja loans, no income, no job, or assets. It sounds insane, and it was. But from Wall Street's perspective, it was pure genius. Here's where the financial alchemy begins. A local bank in, say, Ohio, would issue 100 of these risky mortgages. On their own, they were toxic. But Wall Street bankers had a magic trick. They would buy up thousands of these individual mortgages from all over the country, good ones, bad ones, and terrible ones, and bundle them together into a new financial product called a mortgage-backed security, or MBS. The idea was that by mixing thousands of mortgages together, the risk would be diversified. Even if a few homeowners defaulted, the majority would keep paying, and the investors holding the MBS would still get a steady return. These MBSs were then sliced into different pieces called tranches, ranging from super safe to super risky. The safest tranches, which would be paid first, were given AAA rating, the highest possible score for safety by the credit rating agencies like Moody's and Standard, and poor CES. These agencies, which were supposed to be the impartial referees of the financial world, were paid by the very banks whose products they were rating. It was a massive conflict of interest. They slapped a gold seal of approval on what was essentially a package of junk, and the world bought it. Pension funds, foreign governments, and institutional investors all over the globe, hungry for a safe return in a low-interest rate world, snapped up these AA-rated securities. Wall Street had successfully created a machine that could turn lead into gold. They took the riskiest loans imaginable, packaged them, got them stamped with a seal of safety, and sold them to unsuspecting investors for a massive profit. The banks didn't care if the homeowners could actually pay back their loans because they had already sold the risk off to someone else. It was a game of hot potato on a global scale, and the bankers were collecting a fee every time the potato changed hands. This created a perverse incentive loop. The more MBSs Wall Street sold, the more mortgage they needed to create them. Investment banks called up mortgage lenders and said, "We'll buy everything you've got. Go find more." So lenders scraped the bottom of the barrel, approving loans for people they knew would never be able to repay them, often using predatory tactics and teaser rates that would soon balloon into unaffordable payments. The entire system was built on the assumption that house prices would rise forever. If a borrower couldn't pay, they could simply sell their house for a profit and walk away. For a while, it worked. The housing bubble grew larger and larger. But a few people saw the writing on the wall. They understood that a system built on a foundation of bad debt and a never-ending rise in prices was a house of cards. This is where the next layer of financial weaponry comes in, the credit default swap, or CDS. A CDS is essentially an insurance policy on a financial product. If you owned an MBS and were worried it might fail, you could buy a CDS from an insurer like the American International Group, AIG. If the MBs went bad, AIG would pay you. This sounds reasonable, but Wall Street warped it into a casino. People who didn't even own the underlying MBSs started buying CDSs. It was like taking out a fire insurance policy on your neighbor's house. You were essentially placing a bet that their house would burn down. Hedge fund managers and traders like John Paulson realized the housing market was a bubble destined to pop. They started buying up billions of dollars worth of CDSs on these mortgage-backed securities, making a massive bet against the American housing market. Meanwhile, the banks that were selling the toxic MBSs were also getting in on the action. In a move of staggering cynicism, firms like Goldman Sachs were selling these MBSs to their clients, telling them they were great investments, while simultaneously buying CDSs on those very same products, betting that they would fail. They were selling the ticking time bomb and buying the insurance policy for when it inevitably blew up. By 2007, the first cracks appeared. The teaser rates on millions of subprime mortgages began to reset to much higher levels. Suddenly, homeowners saw their monthly payments double or triple. With stagnant wages and rising costs, they couldn't pay. Defaults started to skyrocket. People tried to sell their homes, but with so many others doing the same, the market was flooded. For the first time in a generation, house prices didn't just stop rising, they started to fall. The foundation of the entire financial system crumbled. The homeowners, the first domino, couldn't pay their mortgage. This meant the mortgage-backed securities, the bundles of these loans, were now worthless. The pension funds and investors around the world holding trillions of dollars in these AA-rated assets saw their investments evaporate. The house of cards collapsed, but it didn't stop there. All those bets, the credit default swaps, now had to be paid out. AIG, which had insured tens of billions of dollars of this toxic debt without setting aside any money to cover potential losses, was suddenly on the hook for an astronomical sum. If AIG failed, it would trigger a chain reaction, taking down every bank it had insured, creating a complete meltdown of the global financial system. Lehman Brothers, a 158-year-old investment bank heavily exposed to this toxic mess, was the first major casualty. In September 2008, it declared bankruptcy, and panic engulfed the globe. The credit markets froze. Banks stopped lending to each other, to businesses, and to individuals. The lifeblood of the economy, credit, stopped flowing. The world stared into the abyss. This is the moment Wall Street, the creators of the crisis, came to the government with their hands out. They argued they were too big to fail, the very same people who had preached the virtues of the free market and fought against regulation were now demanding the largest government bailout in history. And they got it. Taxpayers were forced to foot the bill for their recklessness, injecting hundreds of billions of dollars to save the very institutions that had gambled away our future. The profits had been privatized, but the losses were socialized. The bankers who caused the crash walked away with their bonuses, while millions of ordinary people lost their homes, their jobs, and their life savings. The 2008 collapse wasn't just a financial crisis. It was a crisis of trust. It exposed a system where Wall Street's greed was prioritized over the well-being of society. A world where complex financial instruments were used not to manage risk, but to hide it and multiply it for profit. The architects of the system played God, and in the end, it was humanity that paid the price. The world we live in today, with its deep inequality and profound distrust in institutions, was forged in the fires of that collapse. So I have to ask you, have we truly learned our lesson, or is the system quietly rebuilding the same vulnerabilities for the next crisis? Let me know your thoughts in the comments below. And if this video opened your eyes, make sure you share it. It's a conversation we all need to be having.